All right, let's dive right into this explainer. We're going to uncover exactly how the largest infrastructure build-out in human history, artificial intelligence, is actually being funded. You've probably seen the endless AI headlines, right? The numbers have gotten so astronomically large that they kind of just blur together as you scroll past them. Another 100 billion here, a new mega campus there. But we really need to pause and look closer, because beneath the surface of these enormous announcements is a financial machine operating completely out of sight. So here's the reality check. Big tech is on track to spend $700 billion this year alone on building out AI. To put that into perspective, that's roughly 2.5 cents of every single dollar the entire United States economy produces. I mean, it's just staggering. Yet almost nobody is asking the enormous question staring right at us. How exactly are we paying for this unprecedented build-out? Because honestly, no single source of money on Earth is deep enough to fund this all by itself. The terrifying answer starts with one truly unbelievable number: $1.65 trillion. That is the amount that just 5 major tech companies owe in hidden obligations. We're talking about monumental financial commitments that simply do not appear on their main public balance sheets. It's a massive sum of money, and it's operating entirely in the shadows of the global economy. When you look at the public books for these top 5 tech giants, you see about $1.35 trillion of visible debt. But beneath the surface, that hidden pile is sitting at $1.65 trillion. The hidden debt is literally larger than the visible debt. Take Meta, for example. Their off-balance sheet debt is nearly triple their reported debt. And moving that much money out of sight, well, it's not a magic trick. It actually requires a very specific, complex system. But before they went to the shadows, they went to their own vaults. To understand this funding escalation, we have to look at how the AI build-out completely drained tech's cash reserves. Historically, these incredibly profitable companies spent about 40 to 45% of their cash on capital expenditures, reinvesting in their business. But today, that number has skyrocketed to an absolutely staggering 94%. They're essentially running their entire cash engine solely to finance the AI build-out. Basically, the vault isn't funding the build-out anymore, the build-out is draining the vault. And once that cash ran dry, they hit the bond markets at an unprecedented and honestly accelerating pace. From 2020 to 2024, the biggest hyperscalers were issuing about $28 billion a year in bonds. Then in 2025, that jumped to over $100 billion. And in just the first 5 months of 2026, they issued another $159 billion. Think about that. They borrowed more in 5 months than in the previous 5 years combined. They issued debt until even the deepest capital market on Earth, the US dollar market, literally couldn't absorb it anymore. Naturally, this explosive, basically unquenchable thirst for borrowing caught the attention of regulators. Tobias Adrian, a senior official at the International Monetary Fund, pointed out that the major tech firms leveraging themselves up to this degree is incredibly worrisome for global financial stability. And it makes sense, right? The tech sector quickly became nearly 18% of total US investment-grade debt. So with the IMF watching and the traditional markets completely saturated, these companies had to find a new, quieter way to get their hands on unprecedented amounts of cash. This desperate search for cash led them back to a system that an economist named Paul McCulley actually warned about right before the 2008 financial crash: the shadow banking system. Now, these are institutions that borrow like banks and lend like banks. But crucially, they aren't legally classified as banks. That means they operate with no deposit insurance, no Federal Reserve safety net, and absolutely none of the strict regulations that are designed to keep the traditional banking system safe. To understand how this actually works in practice, let's use a simple analogy with a fictional company. Let's call it Acme Corp. If Acme wants to borrow a literal mountain of money without showing it on their books, they create a secondary company, a special purpose vehicle, or SPV. The SPV takes on the colossal debt, uses that borrowed money to buy the assets Acme needs, and then simply leases those assets back to Acme. On paper, they are totally separate entities with their own separate debts. So the absolutely crucial point here is that it's kind of like opening a credit card in your cousin's name. You're the one swiping the card, you're the one enjoying the purchases, and you're using all the stuff. But when the bank asks about your personal debts, your official answer is technically zero. The liability rests entirely on the cousin, or in this specific corporate case, the special purpose vehicle. Section 1. Project Beignet, hiding in plain sight. Let's zoom in on a specific blueprint for this scheme: Meta's Project Beignet. This is a $27 billion AI data center down in Louisiana. Meta designed it and operates it, but you really have to look at the ownership loophole. A private firm put up 80% of the equity, and Meta took exactly 20%. Now, because accounting rules cap ownership at 20% to avoid being labeled a primary beneficiary, that $27 billion in debt legally and entirely vanishes from Meta's balance sheet. But if you're willing to dig deep into the footnotes of Meta's annual report, you find something called a residual value guarantee. And this creates a fascinating dual narrative. On one hand, Meta gets to tell Wall Street, hey, we didn't borrow $27 billion, this isn't our liability. But simultaneously, they're secretly promising the bondholders, don't worry, if this building loses value, we will write a check to cover you up to a staggering $28 billion. They are literally selling two entirely different stories to two different groups. And honestly, the most dangerous part of this incredibly complex deal is the incredibly risky mismatch in timelines. The bonds issued to build this highly specific custom metadata center run all the way to 2049. That's a 24-year loan. But Meta's lease for the facility, it doesn't even begin until 2029, and it only renews in 4-year chunks. So if Meta decides to just walk away at the end of a 4-year lease, those bondholders are left holding a hyper-customized, completely empty building in rural Louisiana for the next 2 decades. Now, if Beignet was just a one-off, it might just be a clever corporate trick, but it wasn't. Beignet became a template that is now being aggressively copied across the entire industry. BlackRock recently marketed Project Sophia, which is a $12 billion sequel for another metadata center in Texas. Across the tech industry, off-book debt has multiplied by 8 times since 2022. We've seen $120 billion moved off balance sheets in under 2 years. All of this is pushing total hidden exposure across the industry to an estimated $1.8 trillion. And because it's the exact same small club of lenders funding all of these identical deals, the risk stops being diversified. It is literally the exact same bet written over and over again. Experts and lawyers who worked through the fallout of the 2008 financial crash, which, let's remember, was also driven by standardized financing structures spreading rapidly, are experiencing some serious déjà vu right now. When the same structure scales this fast across an entire industry, the structural integrity of the whole system is really put to the test. Section 2. The Four-Legged Parlay, the greatest bet in history. So for this massive $1.65 trillion shadow-funded house of cards to stay standing, it requires a four-legged parlay where every single condition has to hit perfectly. First up, AI revenue has to completely multiply, not just grow. Right now, estimated AI revenue sits around $110 billion a year. But remember, the industry is spending $700 billion a year just to build it. To justify that kind of astronomical, continuous spending, the cash actually coming in from AI services has to scale up exponentially, and it has to do it fast. Second, the returns on these enormous investments absolutely must stabilize. Historically, the cloud giants saw returns of around 40% on their investments, but that number has already slid down toward 20%, with industry projections pointing toward a floor of just 10% if they keep spending at this breakneck rate. These shrinking returns have got to stop sliding. Otherwise, the underlying math of these towering debts simply collapses. Third, the borrowing window in the shadow banking system has to remain wide open. Analysts tally the required tech build-out at roughly $2.9 trillion through 2028. But the company's own cash flows will only cover about $1.4 trillion of that. That leaves an unprecedented $1.5 trillion hole between their planned spending and their actual money. They have to keep finding lenders who are willing to fund these off-book SPVs. And finally, leg 4, the physical infrastructure of the country has to actually hold up. The American power grid has to somehow absorb all these new multi-gigawatt mega campuses without breaking or, causing catastrophic price spikes for everyone else. The largest power market in America is actually already pinned at its price cap. If the grid can't power these massive data centers, the assets just become completely worthless. Which leaves us with one incredibly terrifying question to wrap up this explainer. This entire ecosystem is built on a four-legged parlay of multiplying revenues, stable returns, endless shadow borrowing, and a flawless power grid. So what happens to the AI bubble and the global financial markets that are deeply tied to it if just one of these colossal bets doesn't hit? Just think about that the next time you see a headline about a new $100 billion data center.